Hi everyone, it's your daily business and finance news wrap for this Thursday, the 19th of August 2021. Later, the unemployment rate falls to a 12-year low, but what is the true state of the labour market? But first to how businesses are dealing with vaccines, their staff and their customers. And online jobs marketplace Airtasker is seeking a way to let everyone know if their users are fully vaccinated. It comes as a company which listed earlier this year on the ASX, saw revenues rise 38% year on year, and that's ahead of its prospectus. For more, I spoke with its CEO, Tim Fung. Tim, how would you describe your performance over the past year? And can you maybe give me an update on how many people are actually using the service now?
So we're really excited about our performance over FY21. It's our first year as a publicly listed company, and we, exceeded our prospectus forecasts across all of the key metrics. So it's been a great year as our first publicly listed company. In terms of the size of the Airtasker community, there's now more than 4.7 million people in the Airtasker community. This year we passed by 1 million unique paying customers on the platform, and we've generated more than $1.1 billion in job opportunities since we started.
Lockdowns, how do they impact your business?
So what we've seen over the lockdowns that affected FY20 and FY21 and will affect us into FY22, I'm sure, as well. We've seen a temporary decrease in marketplace activity, followed by the community really finding ways to adapt to life during lockdowns. So, for example, doing a lot of jobs which were previously done in person, now being done either remotely or virtually. And then followed by, as restrictions ease, a sharp recovery. And what we've actually seen is with that pent-up demand that happens during this period, our growth is actually accelerated in the long term. But there's no doubt there are temporary impacts during lockdowns and restrictions, and safety is our top priority. So making sure the community respects those rules is really important to us.
I'm glad you mentioned safety, because you connect tradies, or what you call taskers, which can enter people's homes and complete jobs. How are you managing that COVID safe messaging, and what is your vaccination policy?
So the first thing around COVID safety, we've created a COVID-19 Safety Centre hub, which aggregates all of the relevant information from regulators, government and industry bodies to have it all in one place. And for every task that goes through Airtasker, both the customer and the tasker need to opt in to those, to acknowledging that they are following the rules that have been set out. In terms of vaccination, this is something that we're really supportive of at Airtasker. We're part of the Great Vaccine Drive as an organisation. So all of our employees at Airtasker have paid time off to get vaccinated, and have paid time off to recover from vaccinations if that's something that's relevant to them. We're also exploring together with government the opportunity to be able to create COVID vaccination badging on the Airtasker platform, because we believe that in the during lockdowns and post lockdowns, it's going to be extremely relevant for people to have that kind of information to be able to build trust in the community. And so, just like police checks that we already offer, working with children's checks on the platform that we already offer, COVID vaccination badges and COVID safe badges are going to be really important.
To what extent are you working with the authorities to make sure that taskers are working within the public health orders?
So our policy at Airtasker is to always lean in proactively and have really positive relationships with government, with regulators and industry bodies. Ultimately, what we're trying to do is always the same as what these groups are trying to do, which is we want to create jobs, we want to make sure that people are paid well for those jobs, and we want to make sure that people are safe whilst they're doing those jobs. So we really align and partner with these kinds of government and regulators to make sure that those things are happening.
And finally, what's the company's goals for the next year?
Oh, wow. So we're getting really strapped up for growth. So this year we generated positive operating cash flow of $5.5 million. We've got $46 million on our balance sheet, and we're really getting ready to invest into building out new product, but also international expansion. So we are growing faster in the UK, and we're getting ready to launch Airtasker into the US with starting with cities Kansas City, Dallas, and Miami. So really excited for FY22.
Tim Fung there, the Airtasker CEO, and Airtasker shares closed up 1% today. Now to the market operator, the Australian Securities Exchange, which saw weaker statutory profit of $481 million. That's down 3.6%. As a result, dividends are down 6.4%, but it's maintaining its payout ratio. It did see the highest listings number in a decade over the past year. The company is spending money on technology and had some interesting things to say about first-time investors. For more, I spoke with its CEO, Dominic Stevens. There's going to be a big change when Square eventually comes into Australia following that takeover of Afterpay. What does that mean for the market, and what does it say, I guess, about the ASX role in the technology space, not just in Australia, but in the region or even globally?
Yes, yeah. I think it's a really interesting thing, and and also we've had sort of like BHP coming home, which is another sort of like interesting piece in that puzzle. But to the Afterpay and Square point, I think the interesting thing, if you look out over the last 5 years, ASX used to have 10 years ago quite a small technology sector as part of its index. That has grown quite significantly, and I think that's really good for ASX. But it's more importantly, in some senses, it's really good for the country in Australia that actually we have a more vibrant equity capital markets, such that, if we didn't have that, would Square consider, sort of like listing on our market, even being a sort of secondary, would BHP come home? I think it's a very positive sign about the size and strength of our market across the world.
The pandemic has given rise to a new breed of investor, I guess, first-timers, and they seem to be getting younger. Do you see this trend continuing? And is it a good or a bad thing? Because you only have to look at the rise of meme stocks like GameStop in the US.
Yeah, it's a really interesting question. I think it is good. I encourage people to actually, have a better understanding of their investments, and it is a good thing. My children are sort of like interested in that. I think that's a positive thing. I do get concerned around the meme stock thing, because I think at the end of the day, the value of the stock is not what we think it is. In the short term, it might be, but in the long term, it's the value of the cash flows that come out of that stock. So I think there's some really interesting stuff going on in the US around how the market is being sort of moved around by day traders or whatever. I wonder about it in the long term, but and we don't see it so much here, as we have a sort of a little bit of a different market structure here. We don't have things like payment for order flow and various other things, but I think it's worth keeping an eye on. I mean, to give you an idea, when the GameStop thing was happening big time, we had a stock in Australia that had the same ticker as GameStop, and suddenly, it went for a run one morning. I think it was a nickel stock, and the guy had to get out. We sort of suspended it, and basically they put out an announcement, and it was all fine. But it just shows that there's sort of it's like a herd mentality, and I'm not sure whether that in the long term is actually about investing.
Okay, just 3 more questions. During the year, there were a number of technical issues at the ASX. What's been done to address this? What kind of assurance can you give that it won't happen again, especially at a time when you're going through a major technology upgrade?
Look, and I think that the key point there is we're going through a significant amount of technology upgrade. In fact, our systems, our equity stack of technology will be as sort of young as it's ever been, since going back to when we first actually put in technology in the 90s. So, when we get through the CHESS replacement, the average age of that technology might be only a few years, because we've actually gone through and changed everything. Change is difficult. And so, 2 things is, we're obviously, sorry for the outage last year, and we regret it. But, and I can't take you through all of our slides, but over the last 5 years, the amount of incidents that we have in our technology has fallen something like 80 to 90%. And actually the number of outages have fallen over the last 5 years, a sort of similar amount. So the important thing is, in the big picture, ASX is becoming a much more resilient organisation. We very much regret an outage. And to your point of, can outages happen again? Yes, they can happen again. It's all about trying to get them as infrequently as possible. And the way to do that is get your incidents down to as low as they possibly can. So bringing that all down, I think, is positive. final thing I'd say is the going to the chest replacement. We've got a year set aside just of specific testing of that system. So there's going to be an enormous amount of work gone into testing that program. And the good things is that from the learnings out of what happened last year in November, everything that we've learned out of that, we, as we would always do, take that into all our other projects and make sure that that those things don't happen again.
That is the CEO of the ASX there, Dominic Stevens, on a day where its shares actually rose 2.3%. Now to the broader market, where the S&P ASX 200 fell once again, down by 0.5%, 7,464. For more, I spoke earlier with Kyle Rodda from IG Markets. Kyle, it seems the US Federal Reserve is on track to taper economic stimulus. How has that moved the market, and what exactly does that mean?
Well, basically, just to put it into context, since the start of the pandemic, the Federal Reserve has been buying $120 billion worth of assets, $80 billion worth of US Treasuries, $40 billion worth of mortgage-backed securities a month. And the whole idea of that is just to pump money into the financial system and ideally the economy too, to sustain this particular recovery. Now, over the last few months, obviously, we've been talking about inflation, all those sorts of things, and the fact that the recovery is underway, reopenings occurring, et cetera, et cetera. There is this whole notion now that the Fed is starting to think about pulling back on some of that asset purchases and pulling some cash out of the system, or the amount of cash that it's pumping into the system every single month. So what happened last night effectively is that we had the FOMC minutes from the last meeting a couple of weeks ago, and it's looking very likely now that they're going to start that process at some stage before the end of the year. So the reason why that's relevant to markets is that, we obviously hear a lot about asset prices being inflated, all this money going into equities. That's where it's coming from. And if the taps start to get tightened a little bit, there's just that concern at the margins that maybe there'll be less impetus for the stock market to rise the same way that it has in recent history. So it was a bit of a shock last night, that document for the markets. And it's basically the reason why we saw US equities suffer last night and the ASX 200 start the day off the back foot.
Lots of profit results out today. I just spoke with the ASX's Dom Stevens. What did you make of the ASX's results?
I thought they were pretty solid. I mean, I think everyone was sort of expecting what was conveyed on the revenue side of things, that, we've had an unprecedented boom in retail trading. New listings are up basically because we're in an almost unprecedented bull market. And that's what happens when you're in this kind of, very kind of bullish marketplace. The real kind of concern, I think, for market participants was what the outlook as far as some of these big technology investments that the company was making and how that would affect the company going forward in the next 12 months or so. Lo and behold, what the ASX disclosed more or less was that costs remain under control and future expenses are sort of projected to remain reasonably in line with expectations, and that sort of rollout, that sort of investment in technology will continue to go smoothly. So, there's some lingering concerns that in the future, because of this unprecedented bull market probably coming to an end at some point in the not too distant future, that maybe that revenue side won't be as solid.
And with all the other numbers out today, which were the ones that caught your attention?
Well, for me, and I suppose that's the way that I tend to look at things, it was very much thematic. And we had some really interesting results out of a few big miners, and probably most pertinently Origin Energy. And there was all sorts of things going on at the micro level with those particular companies. But one thing that we're starting to get out from a lot of these names, and it's being reflected in commodity markets at the moment, that this big expansion that we've seen in the global economy over the last 12 months or so is expected to slow down. And for example, what Origin Energy told us is that they expect energy demand to be reasonably soft into the future. And there's this overall concern amongst, say, mining companies as well, that demand for commodities will start to wane. A lot of that's due to the fact that the Chinese economy is slowing down. So we've had a jam-packed day full of earnings, company by company. There was a lot to pick apart. But for me, the themes being pulled apart as it relates to stock market strength going forward is very much along the lines that, that big global growth story is probably not as cogent as it used to be. And that's manifesting in maybe some weaker profits for these sort of commodity players that have been very big parts of this strong market that we've seen in the last 12 months.
And just finally, apart from that, any other trends that you're seeing in profit reporting season so far? I mean, things like dividends, for example, and what does that all mean for investors?
Yeah, well, I mean, overall, you probably give the reporting season a pass mark. for now, and we're coming off a pretty low base last year. But earnings have been revised upwards for the most part. The results in terms of profits for the year have been revised up over the last couple of weeks. And like you said, there seems to be this theme amongst corporates of wanting to give capital back to their investors in some way or another. So we've seen share buyback plans, being launched by a number of major companies, but most pertinently, dividends being increased again, and even special dividends being paid out. So that's really good, because obviously the ASX 200 is a market very much driven by that sort of dividend appeal. Investors have been dividend starved, and even if you look at the way analysts are projecting things into the next 12 months, dividend yields are expected to pick up too, even despite lofty prices. So I think that's been the key takeaway. There's lots of headwinds coming up in the future, and you only have to look at the lockdowns, et cetera, to understand the potential risks for the Australian economy and the market. But overall, investors are receiving dividends again. Corporates are returning money to shareholders, and that's really been an overwhelmingly positive result, I think.
Rodda there from IG Markets. And now to the jobless rate, which fell from 4.9% to 4.6% in July. That is a 12-year low. But given the lockdowns, does it really reflect the actual state of the market? For more, I spoke earlier with the Chief Economist of the Commonwealth Bank, Stephen Halmarick. Stephen, do these numbers truly reflect the state of the employment market right now?
Well, we don't think they do. They're data for July, and they were taken just before the extensive lockdowns would have had an impact on the data. So, the employment number up just over 2,000 on the month. The unemployment rate at 4.6% is the lowest since December 2008. But we do expect a fairly substantial increase in the unemployment rate, unfortunately, as we get the August, September, October data.
So given the survey was taken in the first 2 weeks of July, so that was before the pause in construction in Greater Sydney, is there any data in the actual stats out today that points to the worsening situation?
Well, there's two bits of data that came out today that I think do that. One is the participation rate fell from 66.2% to 66%. So if people leave their job and they don't look for another job, they fall out of the labour force. So we already can see a decline in the participation rate. And also the total hours worked was down 0.2% in the month, but down 7% in New South Wales. So we can see already the number of hours worked declining pretty substantially in New South Wales.
Do you have any idea of what the effective unemployment rate is?
Well, we talk about the underemployment rate, and that actually increased on the month, and that really is reflecting that reduction in hours worked. So you can be counted as employed, but you're working less hours than you want to work, and that underemployment rate rose in July. So that's probably a better indicator of what's happening in the labour market. So hours worked declined. People wanted to work more hours. So even though we saw that fall in the unemployment rate, other indicators showing a weakening in the labour market.
Okay, so combine all of that with low wages growth, which we saw yesterday. Where do you see the employment market going? What are your forecasts for the unemployment rate now, and what does that ultimately mean for the RBA?
So we do think the unemployment rate will rise to 5.6% by October. So up from 4.6% in July to 5.6% in October. So quite an increase. That partly will be due to the lockdown and people, as we talked about before, losing their job, not looking for other employment. And so, and the wages number yesterday was certainly lower than we had thought it would be. And remembering the labour market was pretty hot in the June quarter. So we're expecting the Reserve Bank to raise interest rates around about the middle of 2023. So that's still more than 18 months away. And so we're going to have to see a pretty solid recovery in the economy through 2022 to ensure that the RBA is comfortable in raising interest rates around middle of next year, middle of 2023.
And these numbers, what does it say about the way the economy was performing in the lead up to the lockdowns? Was it as strong as we think? Because we saw those wages data that was pretty soft.
Well, if we look at the activity numbers, the spending numbers, and the labour market, the economy was actually very strong leading into June. As you say, granted, we didn't see that translate into an increase in wages growth, But activity numbers were looking really good, and we were expecting the GDP to grow by 5% this year, calendar 2021. Our forecast now is 3.6%, with a big reduction expected in the September quarter. So, leading into these lockdowns, the economy was in pretty good shape, but no doubt we're going to have a pretty substantial pothole in economic activity for the next 3, maybe 6 months.
Stephen Halmarick there, the Chief Economist of the Commonwealth Bank.
This On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It's not personal advice, and it doesn't consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.